Hi, this is Joe Carapinha, Blue Crow Trading. I want to spend a few moments with you discussing today's price action. Today is May the 28th, 2014. The time now is 8:27 p.m. I'm finished with my post-market assessment, looking back on what happened on today's trading, and decided to record this video to illustrate yet another example of how to use major bull targets and major bear targets. In terms of the prior session, what we saw happen yesterday was a rather significant move and continuous move up, fairly bullish. The expectation would be that eventually this major bull move that continued overnight would have a pullback. The question remains as to where would the pullback, if it did take place, where would it end? And where would it stop? That's where the bluecrowtrading.com intraday targets for the Emini Nasdaq 100 futures is particularly helpful. That before the cash open took place here at 9:30 a.m. This morning, what had already been established in terms of intraday targets was this major bull target at 37.2650. Another one was already set at 37.28, and then major bear targets were set at 37.1425, a second one at 37.11, and a third one at 37.0675. What happened for the rest of the day is that price was constrained between these major bull and bear targets, and there was a two-way auction that was taking place throughout and between these extremes. So the analogy that I wanted to provide in this video focuses on the following: that it doesn't matter where you enter a trade, provided that you know where the destination is and where price action is going to end, and where you generate this significant amount of your profit and income would be on the exit. It's not going to be on your entry strategy, yet a fair amount of a typical trader's time will be spent on nailing and trying to fine-tune the entry strategy, and at the expense of neglecting what the exit strategy should be. And the exit strategy is where profit is generated, as I just mentioned. And by way of an analogy, I want to pull up a separate web page here and pull it up onto the screen and show you the grid map of the MBTA. This is in Boston, Massachusetts. This is of the subway system and the trains connecting to each other, together with the buses and the orange line and the green line and the red line, etc., etc. But the analogy goes as follows: is that if you're on the E green line, and your final destination is Heath, and that's published information, knowing what your final destination is, it doesn't really matter where you jump on. The final destination is always going to be Heath, right? So if you're jumping at Symphony, you know your final destination is going to be Heath. If you're jumping at Museum of Fine Arts, you know it's going to be Heath. If you're jumping at Northeastern University, my alma mater, then you know it's going to be Heath. In each instance, it doesn't really matter where you're jumping on. You know what the final destination is going to be, and that's going to be Heath. And the same thing applies to price action, is that irrespective of where you're jumping on to a train, if you know what the final destination is going to be, where you're going to be generating a profit, it doesn't matter where you get in. So at the 9:30 open that took place here, if you had entered immediately as the market opened, on the cash market that is, you should have known that your final destination is going to be your major bear target. Now, you may ask at this point over here, but there's a major bull target on top. How come, based on that short price action over there, why is it not going to be the major bull target? Well, based on price action, we saw that a new high was created there. There's a first leg that was created, a pull down. A pullback took place. Based on price action, the expectation is that there's going to be a second leg to move down, and that was your second leg. So I was not expecting for a retest of this high. I was expecting rather a second leg to move down to then move me into this major bear target as the intraday target for the NQ. So that was the first intraday target that was achieved, and the same theme happened throughout the day, is that with this pullback over here, knowing that there was a second major bear target that was still out there and needed to be tagged during the day, and then utilizing the same measured move that applied there, that applied here, the next measured move took place there, with that as the new high or the retest of that previous high. The next major bear target that would be targeted, which would be 37.1075, was achieved, and it went over it by a single tick. That would be the next target. Does it really matter where you jump in all of this price action if you know what your final destination is going to be? Well, it doesn't. If you're lucky enough to jump in right at top here in the pullback, well, good for you, because you would have generated a maximum profit from there. Very little risk on top, maximum reward at the bottom. If you jumped in at that spot, you took some heat. If you jumped in at this spot over here, you took a little bit of heat, but you could have jumped there, you could have jumped in there, you could have jumped in there, you could have jumped in this area over here, knowing that the final destination of this train, of this price action over here, is going to be your second major bear target for the day. And then there was a fourth measured move that took place here, equivalent to that one there, to that one there, and to this one over there. The fourth measured move was this move to achieve the third major bear target for the day. I didn't quite get there. I got shy of it by a couple of ticks before pulling back high. So the point of this discussion related to this price action over here is the following, is that you aren't, it doesn't really matter what your entry strategy is going to be, provided that you know what your final destination is going to be. Now the same thing would happen in reverse, is that if you are entering long positions, you're entering long position with the thought and the knowledge that where you're going to be exiting your trade is around your major bull targets. This one on top here that was set at 37.2650, and the other one just marginally above that at 37.2825. That's where you're going to be exiting your target if you're entering long positions here or there for that matter. If you entered there, you took some heat over here, but eventually you got your reward. If you entered there, you took some heat over here before you got your reward on top. That would have then provided you with the necessary intraday target. Your major bull targets intraday are where your demand auctions take place. Your major bear targets is where your supply auctions are taking place. Retail traders, when they are seeing this price action, are jumping in right at the back. They are providing significant supply to very few buyers. From a institutional perspective, this is where there is plenty of demand. From a retail perspective, this is where significant supply is taking place. This is where supply auction takes place, pulls back and heads back in the opposite direction. So with that as the analogy, I just want to repeat it once again, is that the entry strategy is only a minor consideration in developing a profitable strategy. A profitable strategy is significantly dependent on a good exit strategy, and that exit strategy depends on defined intraday levels. The intraday targets that are published on the bluecrowtrading.com webpage provide you with that tool to be able to define dynamically intraday where the exits should be based on price action and based on our Blue Crow trading algorithm and what we share with our subscribers on a daily basis. So thanks for listening. Please take a couple of moments to click on bluecrowtrading.com, click around, have a look at the services and products that we provide. Let us know if you have any questions. We look forward to hearing from you and answering any questions that you may have. Take care. Bye.